We go to activity 8. Michael and Dania. So Michael and Dania are partners in the gift
Start by
business.
what page, please?
That's page 14. 148.
What question started by?
Question 8. So Michael and Daniel are partners in the gift business. The agreement they have is that profit are shared equally, but interest is paid on their capital accounts. So that means each capital invested will determine the amount of profit that will be, or the amount of interest on it. The trial balance of Michael and Daniel for the year that ended 31 December 2019 is as follows. We have the trial balance. The trial balance is balanced already. So now we have the activity, the items in the trial balance. They said the following adjustments are still to be made. There's closing inventory. There's partnership salary to Michael. So Michael is an active partner. Interest on drawings for Michael is 460 and for Daniel is 340. It has been done already. Interest on capital should be at 10%. So 10% of amount invested by Daniel, 10% of amount invested by Michael. So now they said we should prepare the statement of profit and loss account, another comprehensive income and statement of financial position for the year. So we have to prepare an appropriation account. So Michael and Daniel statement of profit and loss account, comprehensive income for the year ended. We have our revenue. So that's the first thing we have to prepare. We have our revenue in the statement of profit and loss and other comprehensive income. Revenue is around 298,715. 298,715. We have our opening inventory, which is 93,460. Now you start your cost of sales. On the other side, we have opening inventory for 93,460. Then we had purchases, 195,220. You had it up. Then we have closing inventory, which is in the adjustment, 132,880. You take it away from it. So your opening inventory plus purchases less closing inventory gives you your cost of sales. So your cost of sales minus your revenue is our gross profit. Did you get it here? So we have 93,460 plus 195,220, which is for purchases. It gives us 288,680. You take it away from your closing inventory, which is 132,880. So we have 155,800.
Yeah.
So revenue, which is 298,715, you take it away from 155,800.
Yes.
That gives us our gross profit. So the gross profit for Michael and Daniel is 142,915. Now we take away expenses. The expenses here are provision for depreciation. We have general expenses. We have salaries and wages, irrecoverable debts.
Yes.
And allowance of provision for irrecoverable debts is not going to be part of the expenses. You take it away from your statement of financial position, from your trade receivables. So here our general expenses are.
Can I see Mr. Adipari, please? Thank you.
So we have general expenses, which is 6,448. We have salaries and wages, which is 43,309. Then we have irrecoverable debts, which is an expenses also, which is 1912. Irrecoverable debt is a debt that's been a bad debt that is written off. It's not going to be recovered. It's different from provision made for irrecoverable debts.
Okay.
The provision depends on the trade receivable. As soon as your trade receivable pays, or the irrecoverable debt is being recovered, you take it away.
Okay.
So here, irrecoverable debt is done. So our profit for the year will be the sum of all expenses minus gross profit, which is 142,915. So the sum of our expenses are 6448 plus 43309 plus 1912, which is 51,669. 142,915, which is our gross profit, minus 51,669 gives us our profit for the year, which is 91,246. So this is what we have to make appropriation on.
Yeah.
So remember, in your appropriation account, the interest on capital will be deducted, the interest on drawings will be added, salary will be deducted, and the rest will be your share of profit. So now we have to prepare appropriation of net profit for the year ended. This is the net profit for the year ended. So the first thing is the interest on capital. It is 10% stated there. So 10% on Michael, which is 67,000, and 10% on Daniel, which is 41,000. So 10% of 67,000 is 6,700 for Michael. 10% of 41,000 is 4,100 for Daniel. Then we have interest on drawing. It has been done already. The interest on drawing are 460 and 340 respectively. Michael 460, Daniel 340. You have to take it away from the appropriation account. The salary, we have only one salary, which is for Michael, which is an active partner, 2,600. Then the sum of this, you take it away from the profit is shared equally,
Yeah.
but we can't get the profit until we take this away from the profit.
Yeah.
So the addition of the 6,700 minus 460 plus 2,600 on the other hand, then 4,100 minus 340 gives us a figure. So here we have the sum of all this, which is the sum of all this minus this gives us 12,600.
Yes.
So 12,600 is the value in the appropriation account.
Yes.
Do you get me?
Yeah, I see.
So the appropriation account has a value of 12,600 when you have added both accounts together.
Yeah.
So it gives you take it away from 91,246. So it gives you 78,642. So that is our share of profit, and profit is shared equally based on the information.
Yeah, I see.
So that means you have to divide 78,642 by 2. So your share balance will be 39,323, 39,323. So it gives us 78,646. So the total balance now will be the sum for Michael, the sum for Daniel. 6,700 minus 460 plus 2,600 plus 39,323 gives us 48,163 for Michael. 4,100 minus 340, that which is interest on drawing, plus it doesn't have salary, so plus share balance of profit, 39,323, so it gives us 43,083. When you add this together, it's still going to give us the profit. So now the profit has been appropriated. For your appropriation, remember profit will be taken away from interest on drawing, interest on capital, and salary. But profit will be added to interest on drawing, because drawing is paid into the business.
Okay.
Is it clear? Both capital and salary is paid out of the business.
Okay.
So you take it away. Drawing is paid into the business,
so
you
you
add
add
it to
inside.
it.
Okay.
You add it to it. Is it clear?
You're so smart, mister. Can I get a response, please?
Thank you. Michael and Daniel, we've prepared statements of profit or loss
For Michael and Daniel.
for Michael and Daniel, and we've done the appropriation account.
Perfect.
So the next thing is to do
The
is
financial
to
position.
prepare statement of financial position, but we cannot prepare the statement of financial position.
That prepared.
We need to prepare the current account before the statement of financial position, because we need the current account balance for
Like the
Michael.
gross profit, everything.
No,
Or what
current
do you,
account balance.
What do you do in current account balance?
In the statement of financial position, the items in the statement of financial positions are your non-current assets, your current assets, your capital. But remember in the last class, we talked about capital, that capital needs to be added with current account.
Yeah.
So both current account and capital account has to be added together.
Add
So that
together.
means, yes, so we need to prepare our current account
Okay.
before preparing the statement of financial position.
Okay.
So now we prepare the current account. For the current account, the items on the debit side, drawings, interest on drawings, salary paid, and the balance.
Yeah.
On the credit side, we have the balance brought down,
Salaries.
salary, interest on capital, and profit for the year.
Yeah.
The share of profit.
This is for current account.
Current account.
And we did capital account. We do capital.
No, for capital account, we don't need capital account
Okay.
because we have it in the statement of financial position.
Okay. Do you do partnership account?
Yeah, this is for each partner, it's written there.
Yeah.
In the statement of financial position, you're going to see each capital for each partner.
Okay.
So we start. Our drawings is 15,800. It's
You just
written in
miss
the
it, just say, no need to say, just say, do you mind only just naming them? Because when you see the numbers, I get confused.
Yeah, the numbers are there. Just try
Yeah,
to
just see the number. Okay.
Okay, drawings. We have drawings, which is 15,800 for Michael. And so we start with the current account on the debit side. We do the debit side first.
Oh, okay.
Drawings for Michael is 15,800.
Inventory.
The interest on drawings.
Interest.
On drawings for Michael is 460. It's written there.
Yeah, what's
Yeah,
this?
Drawings.
Drawings. So drawings, interest on drawings, and drawings.
Drawings is 15,800. Interest on drawings,
Oh.
460.
Do you mind only label it like this? Perfect.
Okay, interest on drawings 460. The salary paid is 2,600. It's stated there.
Yeah, where's the 32,000 came from?
The balance, we leave that first. Leave the balance for now. So we go to Daniel. For Daniel, we have drawings for 16,500. The interest on drawings 340. We stop there. Then on the credit side, our balance brought down on the current account. We have it as the current account capital. The current account for Michael 3114. Current account balance for Michael
33114.
3144.
31444.
And we have
Then a 1102.
Daniel 1102. That's our balance
Okay,
brought down.
perfect.
Then the salary again that
Yeah.
is being paid to Michael, 2,600. Note, as soon as you get the current account balance, you have to add this to it in your statement of financial position.
Yeah.
Okay. So the interest on capital, we did that previously, which is 6,700 and 4,100. We did that here.
Mhm.
The interest on capital in the first account. Where's the paper?
With you, mister. Oh, this one.
Yeah,
I'm so sorry, Mr.
it's
Adebayo.
okay. 6,000, we have it here. Interest on capital,
Right here, Mr.
6,700, 4,100.
Perfect.
So that's the interest on capital, 6,700 and 4,100. Now we find the balance between, we find the difference between the credit side
And the debit
and the
side.
debit side.
So which is?
For Daniel, we have 1102 plus 4,100 plus the profit for the year 39323. It gives us 44,525. Then you take this away from 16,500, 340.
So you minus the debit and the credit.
Yeah, credit from the debit
Credit from the debit. Okay.
because the credit side is more than the debit side.
Oh, okay.
That's why
so
we have
if
a-
debit is more, you minus the debit to the
Then
credit.
your balance carry down will be on the debit
So
side.
it's never minus, like a negative number.
No, positive. It could,
It never could be a negative number.
mostly it's going to be positive.
Can it be a negative number?
Maybe when we're doing, you can have a negative in your control account,
Control
not
account.
here. So here we have 16,500. So the difference between the debit side and the credit side for in the current account for Daniel is 27,685. So this goes to your current account in the statement in preparing your statement of financial position.
Mm.
The item for current account will have Daniel as 27,685.
Okay.
The difference between the current debit side and the credit side of Michael in the current account is 51,767 minus 15,800 minus 4,460 minus 2,600, which is 32,907. But the 32,907 is not what you're going to write. You have to add 2,600
Yeah.
into the current account.
Mhm.
So 32,907 is your balance here in the current account.
Yeah.
But 2,600 will be added into the
Mhm.
statement of financial position.
Yeah.
So the balance in your statement of financial position, I wrote it here already for you. So the balance in your statement of financial position for Michael, because Michael received salary of 2,600,
Yeah.
would be 35,507. Now the current account is prepared. We now prepare the statement of financial position for Michael and Daniel.
And yeah.
So
Mister, I have a question.
yes, please.
So this is the last thing you do.
Yes, sure.
Perfect.
So the statement of financial position for Michael and Daniel.
Mister, did you do question 6 and 7?
No. So Michael and Daniel's statement of financial position as at 31 December 2019.
Oh, 2019.
Yeah.
So all this is between 2019.
Yes.
Okay, I understand. Okay.
So our non-current assets here, we have our non-current assets, we have fixtures and fittings, 22,000. Then provision for depreciation is made for fixtures and fitting. Provision for depreciation is 6,600.
Yeah.
So 22,000 minus 6,600 will give us our carrying value. Assets minus provision for depreciation gives you your carrying value.
Excuse.
So 22,600 minus 6,600 gives us 15,400.
Yes.
That's for fixtures and fittings. Now go to our current assets. In the current assets, we have inventory. It's going to be your closing inventory. We have trade receivables.
So why did I write it?
I wrote it.
Oh,
Closing.
good.
We have trade receivables.
Why did not total do the total amount for non-current assets? Like total up, like provision for depreciation 6,000. Or you might not add them together.
No, for provision, you only have one asset. All these are These are
Why
current
did not
assets.
add all these together?
How can you add cost and provision for
Well, 'cause it's
depreciation?
one asset.
Provision for depreciation is
If
an,
it's sorry,
Can you let me talk, please?
if it's
Let me talk, please.
my bad.
Provision for depreciation is an expenses. You take it away from the cost.
Oh, but if there's two assets, you add them.
If there are two assets, they will give you provision for depreciation for the next asset.
Oh, okay.
So here, the current asset is inventory, which is closing inventory 132,880. Then we have our trade receivables value, which is
the money for numbers.
trade receivable value, which is 38,700. You deduct allowance or provision for incurable debt of 900. So for trade receivable, it will be 38,700 minus 900.
Mm-hmm.
So that gives us 37,800. Then cash at bank, it's written there, bank 6512. Then you add them together, which gives you 177,192. So 177,192 plus 15,400 gives us the value for the total assets to be 192,592.
Yes.
That is the assets part, which must be equals to the liabilities,
Yes.
capital and liability.
Yeah.
Your statement of financial position. Now we go to, can you just tell that over there, please? We go to capital and liability account. So for capital, we have Michael. For capital for Michael is 67,000. The capital for Daniel,
It's
41,000.
41,000.
So the total capital now is 108,000. Capital is done. Now our current account, we have it in our current account, the current account balance. For Michael, which was previously done. For Michael, 35,507. And for Daniel, 27,685. You add them together, that gives us 63,192. 63,192 minus 108,000 gives us 171,000.
Add them, not minus.
You minus it, please. You add, sorry. Because asset, it's still capital, so you had it, sorry.
You can just write it here, mister.
So you had it here. So, because our capital will now be closing, opening capital plus liability to get closing capital. So 108,000 plus 63,192 gives us 171,092.
Yes.
That's the closing capital. In our current liabilities, we go to our trade payables. Our trade payables here, we have it as 21,400 trade payables. You add it to 171,192.
Which is 192,000, perfect.
So that's 192,592.
Thank you so much. You're so smart, mister.